Restaurant business funding. How much money do you need? Call 888-653-0124 today or click the link in the description to learn more. Looking to start a restaurant business or expand an existing one? If yes, then consider applying for a loan from a bank or other financial institution. A restaurant owner has to make sure that she has enough capital to cover their expenses. In order to get a loan, they should have an excellent credit history and a solid plan for running the business. There are two main types of funding sources for restaurants: equity financing and debt financing. Equity financing is where the investor provides the startup with cash up front. Debt financing is where the investor lends the startup some amount of money, which gets repaid over time. Restaurant sources of funding. Restaurants need money too. A restaurant needs money too. If you are a new restaurateur, you may wonder how to get started. As a first-time entrepreneur, you can find yourself overwhelmed with all the tasks involved with opening a restaurant. This includes finding a location, hiring staff, buying equipment, obtaining licenses, and more. Fortunately, there are many ways to fund your business. The restaurant industry is one of the most competitive industries in America. Because of this, it's important to know what steps you need to take in order to succeed. The following tips will help you launch your own successful restaurant venture. Cash flow gaps occur when a company spends more than it takes in during a period. These gaps can lead to problems, such as declining sales, increased costs, and even bankruptcy. Restaurant owners often struggle with cash flow issues because of high fixed costs, especially rent. To avoid these problems, restaurant owners must manage their finances well. Eligible restaurants can receive a restaurant business loan up to $2 million through the Small Business Administration, SBA. To qualify for SBA-backed loans, businesses must meet certain requirements. They must be owned by U.S. citizens or residents who live in the United States. Applicants must operate at least 40% of its services within the United States. How restaurants can acquire restaurant financing. When you're looking for restaurant financing, there are two types of funding available: debt and equity. Debt financing is when you borrow money from a bank or lender. Equity financing is when you invest your own money for ownership of the company. Debt financing is usually cheaper than equity financing because banks and lenders offer lower interest rates. However, you must pay back the loan at some point. Equity financing is typically more expensive than debt financing because you need to put up your own capital. But, you'll be able to keep 100% ownership of your company after paying off the loan. If you're looking for restaurant funding, consider both options. The type of financing you use depends on your personal situation and financial goals. For example, if you're just getting started, you may not have enough cash to cover the cost of a $10,000 loan. So, consider taking out a small amount of debt financing. If you already have a lot of savings, you may prefer equity financing. This way, you can avoid borrowing any additional funds and instead invest your own money in your company. But keep in mind that equity financing comes with risks. If you cannot meet your obligations, you could lose everything. And, if you don't succeed, you won't get anything back. How to find investors. Finding investors is a critical step in launching a restaurant business. The right investor can help you launch your business faster, reduce risk, and ensure its long-term viability. However, finding investors isn't easy. There are many types of investors out there, each with their own unique needs and requirements. To find the perfect investor, you need to understand who they are and what they're looking for. Once you've done this, you can use these tips to attract them to your restaurant business. First, identify the type of investor you're seeking. Are you looking for angel investors, venture capitalists, private equity firms, banks, or government grants? Each type of investor has different criteria and expectations. Next, determine the amount of money you need to raise. This number depends on several factors, including the type of funding you seek, the location of your restaurant, and the size of your team. Finally, consider the risks associated with raising capital. Some investors may require a large stake in your company, while others prefer a small investment. Once you've identified the type of investor you want, you can tailor your pitch. Start by explaining the benefits of investing in your restaurant. Then describe the challenges you face and how you plan to overcome them. Finally, ask if they'd be interested in meeting with you. If you don't get any interest, keep refining your pitch until you find the right investor. What to consider when seeking restaurant financing. If you're looking for restaurant financing, there are several things to consider when seeking funding. The most important consideration is whether you need the money now. If you need the money right away, then you should seek short-term loans. Short-term loans are usually paid back within 30 days. They're ideal for small businesses that need cash flow fast. Another consideration is whether the loan is secured or unsecured. Secured loans require collateral, such as real estate or equipment. Unsecured loans are typically used for personal reasons, such as paying off credit card debt. Finally, ask yourself whether you can afford to pay back the loan. If you can't afford to repay the loan, then you shouldn't take it. There are many types of restaurant financing available. Some are better than others, depending on your situation. Here are some questions to ask yourself about restaurant financing. Do I need the money now? Is this a secured or unsecured loan? Can I afford to repay the loan? What type of restaurant financing am I looking for? Where can I find restaurant financing? Who can help me find restaurant financing? Alternative lenders offer competitive rates and flexible repayment terms. These alternative lenders work with many types of businesses, including restaurants. For example, a restaurant could apply for a line of credit from one of these alternative lenders. A line of credit allows you to borrow funds against future sales. This type of financing also comes with fewer restrictions than traditional bank loans. For instance, you won't have to put up collateral, like real estate or equipment. Instead, you'll only need to provide proof of income. You can also access alternative lenders' lines of credit without having to close your existing business account. These lines of credit are great for restaurants because they allow you to make purchases without tying up your operating account. You can use these loans to purchase inventory, hire employees, or even invest in marketing. Alternatively, you might look into merchant cash advances. These loans let you buy items at retail prices, then sell those same items later at a higher price. How restaurants use loan guarantees. Restaurants use loan guarantees to finance equipment purchases, remodels, and expansions. They're also used to fund restaurant operations, including payroll, rent, utilities, and insurance. When a loan guarantee is used to finance a restaurant operation, the lender receives a percentage of the loan amount as a fee. This fee is called a loan guarantee fee. Here's how loan guarantees work. The borrower applies for a loan guarantee. The bank approves the loan and gives the borrower money. The borrower uses the money to purchase equipment, remodel, expand, etc. After the loan is paid off, the lender sends the borrower a statement showing the total loan amount, interest rate, and loan guarantee fee. If the borrower pays back the loan, the lender keeps the loan guarantee fee. If the borrower defaults on the loan, the lender collects the loan guarantee fee. This is a great way to raise capital for your restaurant business. How restaurants raise capital through franchise deals. Franchise deals are great ways to raise capital for restaurant businesses. They're especially helpful when restaurants need to expand quickly or open multiple locations. However, there are many pitfalls to avoid when raising capital through franchise deals. The biggest pitfall is not understanding the risks involved. Here are some things to consider when deciding whether to pursue a franchise deal. Is the franchise deal right for you? Are you ready to commit to the long-term commitment required by a franchise agreement? Do you understand the financial risk associated with a franchise deal? Will you be able to afford the upfront costs associated with a franchise deal, such as signing a lease? Does the franchisor offer any support services to help you succeed? What happens if the franchisor goes out of business? Can you afford to lose money if the franchise fails? If you answer yes to these questions, then you should proceed with caution. Franchising is a complex process, and it requires a lot of work and planning. Before committing to a franchise deal, you should thoroughly investigate the franchisor and its offerings. Also, be prepared to invest a significant amount of time and effort to build your brand and establish yourself in the marketplace. How to determine whether a franchise deal will work? Call 888-653-0124 today or click the link in the description to learn